Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Hey everyone, it's June 26th, 2022. Another Market Radar podcast, episode 17. The S&P is down 17.87%, NASDAQ down 25.95%, Russell down 21.29%, Dow Jones down 13.29% year to date. All indexes continue to be deep bearish trend. Our model is signaling a 41.4% stagflation. We're still in heavy stagflation. And a total chance of risk off of 76%. Let's take a look at what we've got going on in this next week. Monday, we have durable goods orders, pending home sales index. Tuesday, we've got international trade in goods, Case-Shiller home price index, consumer confidence. Wednesday, big day, we've got GDP, Powell speaking, EIA petroleum status report. So that's the big day to watch out for Wednesday. Thursday, we've got jobless claims, personal income and outlays, Chicago PMI, EIA natural gas report, and the Fed balance sheet. Friday, we've got PMI manufacturing final, ISM manufacturing index, and construction spending. Let's take a look at ES for this past week. Pretty strong week across all indexes. This is pretty much a bear market rally. Nothing has changed. Shorts covering bear market rally at the end of the day.
Yeah, it's what we've seen a few times actually so far this year, where you get big pressure into basically a big liquidations into Momo. I mean into lower vamp, and then reversals towards upper vamp. And this is common. This is this is basically the complete opposite as what you would see in a bull market, where you have liquidations to lower vamp. And then they bounce to upper vamp, pushing through the highs and continuing higher. What we're seeing now is the complete opposite, where we're pushing to lower vamp.
This is essentially just price action, right?
Right. Yep. This is bearish trend price action.
Nothing goes straight up or straight down. You just
in a straight line.
Yeah, in a straight line. So this is to be expected. This is why you never short lows and buy tops, and that's exactly what our DDAP indicator is meant to stop you from doing. So
right.
Realistically, we could see upper vamp.
Yeah, exactly. So what basically simplified, instead of shorting these, like instead of doing breakdown shorts where, like, let's just say you wanted to short the breakdown here, which depending on your stop would have worked, the time to short was here. The time to short was here, right? The time to short was here, where we started putting on shorts. Not here or here or here, because what ends up happening is you put yourself in a position for an easy squeeze.
Exactly.
And getting out and getting squeezed out of your own positions, which is not what you want to do. But let's talk about this bear market rally. Let's talk about why is this a bear market rally, and what we expect to happen in SPY or ES.
Like, how do we know that this is not the bottom?
Right. So let's take a look first at HYG. If for those that are new to the podcast, don't follow us closely, probably don't know what this is. Well, HYG is their high yield bond ETF, and we overlay this with SPY, adjusting for dividends. So if we disable SPY, you'll see HYG goes up over time. If I were to take the dividends off of this, you'll see that it goes down. That's because the dividend yield is paying more than the depreciation of the ETF. So it actually goes up if you were to reinvest dividends, which is the whole point. Which gets basically, by reinvesting dividends, you mirror this towards a risk asset, which it's a risk asset in the bond category, right? But it's the riskiest bond category, but you want to put it besides defaults, like a default or bonds in default state, which obviously is the riskiest. But what I'm saying for the purpose of how we look at this comparing it to equities, if you look at a flow chart from the top to the bottom, this is the level before you get to equities. High yield credit above equities. We like to compare bonds to equities. This is how we do it. We adjust the data for dividends to show as if you were actually holding the bonds like an equity and you were just reinvesting the dividends. This is what it would look like. This is what your account would look like over time. It would go up in value.
And
But
so,
if we
what's this telling us now?
right, so like let's overlay this with SPY. So we're gonna overlay SPY. We already did that. And what this is showing you is while SPY has taken back almost half of its June decline, uh, from early June to the bottom, which was the FOMC. Right after that, now we're back up. We're almost half. HYG is not even close.
Yeah, you're not really seeing the same kind of move
Right.
in junk
You're,
bonds.
right. You're not seeing the bounce in junk bonds, meaning risk is not coming in. Now, can risk come into junk bonds and it still be a bear market rally? Of course. Look what you had in May. You had the rally. In March, you had the rally off the March lows, which sent SPY really up there. I mean, this was an aggressive rally in junk bonds in a short period of time, which pushed SPY a lot higher than most people thought. Long story short, this what I'm trying to emphasize is this has legs. Junk bonds can come up much more and still be bear and still turn to shit, which can push ES up easily to upper vamp. So if you can't handle a move to ES upper vamp or ES Momo, you're in too big size. Your size is too big. You're over leveraged,
Yeah, exactly.
right?
And
So
as we've been saying, like this is not the regime to use leverage in. This is the regime
right.
to play it cool,
Yeah, I mean
hold cash.
it's not so much using leverage. It's being so concentrated in leverage, right? Because we use leverage in the public account, but we have over 50% cash.
Exactly. Yeah.
So this gives us the opportunity that when the time is right to really take size, we can pivot with size, and we're not holding the bag across the board. That's the big key. So that's pretty much HYG what we're looking for. We're thinking that this bear market rally has legs. If this was not a bear market rally, um, automatically you would see the market being led by HYG.
Mm-hmm.
So, for example, here, HYG recovered 50 in 2021 and 20 in the crash of COVID. What people thought was a bear market rally, right? This whole way up, it was bear market rally. HYG recovered really, really quickly. HYG broke the highs before SPY. Excuse me. HYG got above the 50% move within by like May or June. That's when HYG was already in probably the top 20, top 75% retracement.
So
I mean,
that's the kind of move that we'd be looking for
right.
in a
Like,
bottom in equities.
let's see. I mean, I don't use these often, but this is just for illustration. Yeah. I mean, the retreat, this 61, what the, I mean, I know what these are, but I want to see 70%. Let's see. Let's see. It'll show me. No, it's not going to show me. I don't mess around with these too much. But long story short, I know this is a 61.8% retracement from the move from top to bottom. So as you can see, we got there. We got back within that move rather quickly within a few weeks of the bottom,
Yeah.
which showed
Way
you that there was
faster than equities
right,
did.
way fast. That's my point. Way faster than equities, right?
And we're not seeing that now.
We're not seeing that yet, right?
Yeah.
Could that happen? Yeah, but you would see an explosive move off the bottom. I mean, even here, in 2018, you saw the high yield bonds recovered much quicker, right? Look, 2018 high yield bonds adjusted for dividends broke their highs here.
Mm-hmm.
You see that? So
Yeah.
they basically broke their highs before SPY did. Um, and this was just such a traumatic event that it took a little bit longer. But generally, when the highs were broken here, we were almost in line. So long story short, it's the recovery that matters in high yield bonds, and we are not seeing a recovery that really screams risk on yet.
Well,
So
also at the end of the day, nothing has really changed.
nope,
We're
nothing has
still in the
changed.
same situation that we were at earlier. We're still in
Right,
a rate hike cycle. And
exactly.
on that, let's take a look at ZN.
Oh, real quick though, we got to talk about VIX
Okay.
quickly. Before
Yeah,
the
let's talk
reason
about
why
VIX.
the only reason I want to break this in is because those who follow us know we look at the ANFCI. Long story short, it's I'm going to keep this quick. It's the Fed stress index, or the financial stress index. If you uh, have any questions, we have a whole podcast about that. You could take a look at it, and it also measures liquidity. We have this closing now at you know zero not was it 0.08. I'm sorry, 0.08. We are now well above zero. We had a tough time breaking above zero the last few weeks. We are now well above zero. And I'm going to just draw a quick line in here so we can see what this looks like at zero right here. So we're now well above zero. What we do know about ANFCI and VIX is they move together. Because remember, as liquidity gets tighter, right, less liquidity, volatility expands. So this move here, you would, as usual, as this goes up, this is going to megaphone to greater width, meaning that VIX top is not in most likely. What
Hmm.
I'm trying to say is the fact that keeps breaking higher, VIX can very well squeeze higher too. If we look back in time on a weekly chart, you can see that as this goes up, VIX follows.
Yeah. So
Now,
it's
right?
essentially like it's the with the NFCI at these level, it kind of makes a breeding ground for higher volatility.
Right.
So it's easier for volatility
Exactly.
to increase in these
Exactly.
conditions.
Now if we look at VIX where it is right, ANFCI is breaking highs, right? So ANFCI is above the March highs. VIX is still under the March highs. That's how we look at it in reference, right? ANFCI is back to May 2020 prices. VIX, I'm not saying VIX is going to go to 55, but just think about it. Liquidity is much tighter. Market can be much more volatile. VIX 27 doesn't seem like it's appropriate,
Yeah. And that goes
right?
both ways too, right? It goes
Right.
like volatility to the upside as well, right? So bear market,
Yes.
like vicious bear market rallies.
Right. Well, yes and no because that only lasts a few. That whole volatility thing where you have a strong market, a strong rally up, adds basically momentum to VIX calls and IV gets pumped, but it doesn't last as long as momentum to the downside.
Yeah,
Like
but
when you see when
with
you
the
s-
lack of liquidity is what I'm saying. So with the ANFCI being at these levels, the lack of liquidity means higher moves both directions,
Oh, right,
right?
yes. That if that's what you mean, yes,
Yeah.
exactly. So, this liquidity is dry, this is a signal of dry liquidity, excuse me, and that's going to mean that VIX itself has basically legs. When it if it wants to squeeze, it can squeeze. Every time you've seen ANFCI up at these levels, you've seen you've seen VIX well above. Here, let's see. Can we draw a line where we are right now, and we'll go back in time? Let's see. You've seen VIX, 50. This is 2008, but regardless, you've seen VIX in the 40s, just under here, just at is this I think this skewing is wrong. It's long. Let's go back out. Let's look at it like this. Here, yeah, it's wrong. Let's go here. Okay. So, yeah, this is right. So VIX is should be above the 2016 levels where ANFCI started to break out. Right? You see ANFCI breaking out, and it basically peaks at negative 23. VIX had megaphone moves all the way up to the low 30s. Let's put a line here. ANFCI is now well above that. So VIX can have megaphone moves much higher is what I'm trying to say.
Hmm.
And I think
Yeah.
that's where we're going to leave that off. So just be careful because volatility is not volatility. The peak in volatility doesn't seem like it's here just yet.
Yeah,
Um,
exactly.
let's go to ZN.
Yeah,
And
let's talk about
this
this. So there's actually been quite a few people calling a demand destruction already, with the way commodities have been pulling back, crude oil's been pulling back a little bit, bonds bottomed a little bit. A lot of people are thinking deflation is coming now. Deflation is here.
Yeah, and I don't think that's applicable just yet. As you can see, if deflation was here, we would see it. We're still what's the spread here? 3, right? 6.3%.
But also, so what do we have to back that? We have our model, which we trust, but like, there's, no one knows what our model is. Well, we kind of, we try to explain it as best as we can, but the inner
Right.
workings, what do we have to back our idea that inflation has not peaked? So we have real yields, which we're going to talk about, and we
Right. We
have
have them here.
crude oil. So
Yeah.
that's what we're going to talk about today. We're going to explain why we don't think inflation has peaked. And this move that we're seeing in ZN right now, we don't see this as a permanent reversal here. We're likely going to see lower lows. We're still in a rate hike environment. So we're either going to see lower lows or chop for quite some time.
Yeah, let's actually talk about that real quick with the rate hike. So this is what this is the model that we built that bases the number of rate hikes or cuts being priced into Fed funds futures, and it's going to be displayed on the website soon. We're just working on figuring out where we're going to put it and how we're going to display it. But for the sake of the podcast, we're going to just show you a screenshot of the model that we took right before the podcast was recorded. So this is as of Friday's close, and as you can see, it almost looks like a downward slope, right? So they're basically what the Fed funds futures are pricing in right now is about 3 rate hikes at the next meeting. We'll see if maybe we come in at 50 basis points or 75, but we're pricing in 75 basis points right now. And then we're pricing in almost 2 rate hikes at the following meeting, and then 2 rate hikes following that. And then once you get under one whole number, um, it becomes like here we could get 1 rate hike, but this becomes less and less probable that you get like more of a pause, right? Oh, excuse me, it becomes less probable that you get a rate hike, and you end up with more of what's like a pause because you're not going to get 0.35% or 0.35 of a rate hike, right? You're either
Mm-hmm.
going to get 1 whole rate hike, 2 whole rate hikes, and if it's very close to 1, the probability is this is basically what this is showing you. This is 35% chance of 1 rate hike. You see what I'm saying? This is 70% chance of 1 rate hike. So the odds of this being a rate hike coming in are much higher than this, and so on and so forth.
Mm-hmm.
And the odds of this being rate cuts, again, 24% rate cut, right? That's not something that we're gonna see right away.
Yeah.
20. We're not going to bet that 24%, 24.8% is going to actually be a rate cut, if that makes sense. It's only 24.8% probability.
Mm-hmm.
Where this is 100% probability of 1 rate hike, 100% probability of 2nd rate hike, and then a 94.8% probability of a 3rd rate hike. So that's why we say 3 rate hikes are being priced in. Where
Yeah.
here it's 100% probability of 1 rate hike and then 63% chance of a 2nd rate hike.
And
So we're looking at 2, 1, and maybe 2, and then 2. That's really the bulk of what's going on here. So what this is telling you is that inflation, the Federal Reserve still has to do X, Y, A, B, C, primarily because we're not too sure about what happens after November yet. This will get priced in over time, but they have to do A, B, C to tackle inflation.
exactly.
So
And
far.
so like the bond market is not buying this whole peak in inflation. Why would they be why would the bond market be pricing in rate hikes if inflation has already peaked?
Right. Right. And they're basically, it's basically what you're trying to say, I guess, simply is the bond market is telling you A, B, C need to happen for inflation to be fixed. If A, B, C do not happen at this point of time, inflation can run away from you. Now, how do these numbers change? It's very important you guys understand this because these numbers will change. If let's just say we out of nowhere we get huge demand destruction, right, and commodities just start really falling apart, these will go away.
Mm-hmm.
Now let's just say commodities start tearing back to the moon, these will have to get pushed higher. As of Friday, this is what needs to happen to tackle inflation.
Yep.
Make sense?
Yep.
Okay. So now let's go. We covered ZN and how we don't think that this is the lows, right? That's what we said. We're going to go into real yields and inflation. So inflation put a new high in real yields in this inflation reading. Real yields pretty much went vertical. Obviously, as inflation rises, real yields are going to go more and more positive because the the way the Federal Reserve fights inflation is by tightening the economy, which pushes real yields higher. Okay? That's how this works. If the Federal Reserve has to do more, real yields will go higher. If the Federal Reserve has to do less and pivot, the real yields will peak and go lower. As you saw here in 2018, Powell pivot, real yields went down, and we got and in deflation. Deflation is usually encompassed by decline in real yields, and that's the pivot we're looking for. We're looking for the pivot to deflation. So if we get a pivot to deflation, real yields will have peaked and it will go lower. Real yields like to go in synchronous with inflation. So we did real yields. We're not really picking up that huge the huge policy change from the Federal Reserve of having to go 75 basis points the next two meetings, which once that priced in, real yields went up. Now,
Mm-hmm.
if that curve that we showed you, or I just showed you, the Federal Reserve hikes and cuts, if those hikes start fading, real yields will have peaked.
Okay. So,
This is pricing in as of Friday, right? This is pricing in the chart of all the rate hikes the Fed's going to have to do.
and so as of now, it it sort of looks like it peaked. How do you see
Sort of.
this?
Yeah, I see this as of now, the high and real yields are in. Do I think that the high and real yields will hold? That would come back to does inflation slow down? And this is going to go to our next segment of crude oil. So remember, the biggest factor of inflation is energy. If energy has not peaked, inflation has not peaked most of the time. So if you need to know if inflation's peaking, just look at what energy is doing. And
Yeah.
this part of the video, or this part of the podcast, we're going to get into what are crack spreads. Okay, this is important when you understand how oil production takes place. We are not going to go into extreme depth of crack spreads. We are not going to tell you how to how to use crack spreads in your trading or how to make money with crack spreads. This is merely
An
a bird's eye view, an
observation.
an observation, bird's eye view of crack spreads, why they're important with inflation. So let's start with what is a crack spread. This is a refining term. It's used to describe the price difference of a refined product in crude oil. For example, a 1-to-1 crack spread would be the difference between the price of a barrel of gasoline and the price of a barrel of oil. So let's just say a barrel of crude costs $40 and a barrel of oil, or gasoline, excuse me, costs $60. The crack spread would be $20, meaning they could buy a barrel of oil for 40, refine it into gasoline, and make $20 a barrel. Right? That's how that
Yeah.
works.
Okay. So it's like
So
profit margins.
exactly. Now the most important crack spread though is known as the 3-2-1 crack spread. This is the one that most refineries run. When you're looking at XLE, a lot of these oil companies are running 3-2-1 spreads over time. They may shift them depending on demand, but most of the time they're running a 3-2-1 spread, which is the difference between the cost of 3 barrels of crude against 2 barrels of gasoline and 1 barrel of diesel. Meaning, if they buy 3 barrels of crude, their profit margin of producing 2 barrels of gasoline with that and 1 barrel of diesel. So 3, 2, 1, 2 plus 1 is 3. 3 minus 3 is 0. So they're taking in 3 barrels of crude and they're producing 3 barrels of they're buying 3 barrels of crude to produce 3 barrels of something. Usually the 3 barrels are 2 barrels of gasoline and 1 barrel of diesel. Now, let's get into what this looks like on a chart. We open up to see a crude oil chart overlaid with crack spreads. You'll see that these are the crack spreads. So this is we're not running a 3-2-1 crack spread on this chart because we want to break down individually what it looks like for each unit. Remember, the 3-2-1 crack spread means that there's 2 barrels of gasoline and 1 barrel of diesel. We're gonna lay this over so you see the price of 1 barrel of everything: 1 barrel of diesel, 1 barrel of gasoline, and 1 barrel of crude. Now, let's just make note that gasoline, is very, very important. It is pretty much almost half of the energy or oil consumption in this country is gasoline.
Yeah. And that's why typically they do 2 parts gasoline, 1 part
Right,
diesel, right?
right, right. And the problem we have right now is this whole Russia-Ukraine issue has put a gridlock to foreign production of diesel, right? Because they need and they need to get crude to produce diesel. Diesel is not something you drill in the ground for. It's produced from crude. So they have a problem with getting crude, with refining the diesel over in Europe. So what is America doing? Well, America is saying that it is it makes sense to export more diesel because the demand the foreign demand for diesel is so high that we should just be exporting diesel instead of producing gasoline right now.
So they make more
And
money refining
yes,
to diesel than they
yes,
do for
yes,
gasoline.
yes. And rightfully so. I mean, they're business too, right? They're going to do what they got to do, and it sucks for for us, but even what they're doing, and this is we're gonna talk about how the problems with energy. So let's break away from the crack spreads for a second and let's understand this. Crude oil is going it's at pretty much 2014 prices. Okay, and why is that? That is not because this is not because ExxonMobil's greedy. Okay, this is not why crude oil is at $107.
Yeah.
Most of the time, a lot of these gasoline companies are buying oil to begin with. So or I should say, they're outsourcing the refining of the refinery process of this, and they're buying it on the open market. Like we import crude from around the world. Just remember that we import crude from all over. So it's not like Exxon is setting the price for crude.
Mm-hmm.
There's an open market demand. Let's overlay this with oil rigs. This is the most important thing. If you look at it back in 2014, crude was at 104, 107, 100 plus a barrel. We had about 1,500, from 1,400 to 15 to 1,600 rigs online.
And so that white line is rigs in operation.
Yes, this
Okay.
white line is rigs in operation. And for those that are just listening, just think of it like this. We had about 1,500 oil rigs for $100 crude oil. Then we had the 2014 oil slide and whatnot, and the rigs came offline, went all the way down. And back in 2018, we bounced up. We only came up to 863 oil rigs. Crude was $70 a barrel, but we still had in 2018, going in 2018, we had the deflation, the stagflation deflation problem, right? So what ended up happening was crude never really accelerated higher, which again also this whole 2014 plus era of all these restrictions we've done on gasoline and basically this whole environmental issue of like we don't want we want to go green, all this stuff, all these pushes against gasoline companies to prevent mining and refining obviously also prevents them from bouncing back from whenever there's a drawdown, because it makes less over time, it makes less and less sense to set up oil mining and oil refining in the United States.
It's just
So the
less
United States,
profitable. It's
yeah,
an easy
exactly.
way to think about it is exactly what's
Yeah,
happening with crypto now. All these crypto miners are now selling their rigs, selling their
right,
mining rigs because it's not profitable anymore at the current prices.
right. Certain coins, yes, right. That's what
Yeah,
you're saying
yeah,
basically
exactly.
with consumption of energy and all. Yes, exactly. That's what this is, right? So let's take a peek at what happens here in 2020. Well, in 2020, we have this whole issue where the oil rigs actually were, we were down to basically 180 oil rigs, or
Yeah,
100 and yeah,
that's from
180 at the lowest.
COVID demand destruction when
Right.
the
We
whole world
we
shut down.
we started at 682. We went down to 180. We are now at 594. We are not even at pre-COVID levels. Forget 2018 levels when crude was $73 a barrel, and forget 2014 levels. The last time crude was at $108 or $107 a barrel, we had 1,500 rigs online. We have 3 times less rigs right now.
So what does this mean? This means they can't keep up with the
Right.
demand.
Right. The demand for oil is steadily outpacing the ability to replenish the supply. So think of it like this: demand destruction. If oil is so high at 107, right? 108, what type of demand destruction needs to happen if oil rigs are the last time we had demand destruction, we had oil rigs at 1600 oil rigs. We're at 500, 600. How do you like there's just so much more demand than there is supply.
Yeah, it's like we're not
You'd have
even near an equilibrium.
right,
We have to get to the
right,
equilibrium first, at least, before seeing demand destruction.
right. And now let's take a look at crack spreads, right? Let's start with diesel. It's right now it's 75.62. What does that mean? That means for every barrel of oil crude that they buy, okay, for $107, they make $75.62 on that. That's what is that? A 75% margin?
Yeah.
Yeah, literally a 75% margin. You're talking about ridiculous. Now, why? Now they'll still, the media will tell you, oh, crack spreads are ridiculously high. Why is that? I'll tell you why that
Does the
is.
media ever even talk about crack spreads? Like, I don't think
Well,
anyone's heard of this
well,
shit.
actually, there's a letter a couple of, I don't know how long ago I saw it. It was floating around. I think it was like a month ago, where the White House talks about like crack spreads are insanely high. Again, they don't know what they don't know what they're really talking about, unfortunately, because they want to shoot they like to shoot the messenger in the foot, or basically shoot themselves in the head because like you want to ban all this oil production. You campaigned on this. You ran like again. This is not to get political, um, but you run a campaign on basically bashing oil companies, and now our rigs are at we're running rigs at 594 rigs right now.
Yeah, they
Like
kind of like did it to themselves.
yeah, like I mean it's not like let me explain something to you. It's not like they went down and they can never get back up. These things went up. There's actively more and more rigs. It's not like rigs are peaking and declining. Like there's actively more and more rigs
Well, it's
as we
also
go.
like it reaches an equilibrium, right? So if there's money to be made, there's gonna be more rigs opening up. It just takes
Yeah, but
time, right?
it takes time. But the problem is it's also a new rig. So to produce, so let me explain this to you, to everyone that's listening, because they might just think, oh, just go produce just make new rigs. The cost of getting a new rig and putting it together, if you can look this chart up, it's like new wells to existing wells. Um, the last chart that I saw was $30 for between $30 and $40 for an existing well. Meaning, if a well exists to basically pull oil out of that well costs $30 a barrel, roughly $30 to $40 a barrel. To put a new rig together, you're running upwards of $60 to $70 a barrel. So it's almost because what ends up happening, you have to look at it as a term of an investment, right? If you're putting a new rig together right now and oil goes to $50, it's going to take you so long to recoup, or it might not ever be a profitable gig for you because of all the regulations and costs and taxes it takes to basically get into the space. You have to amortize those expenses and basically calculate where your break even oil cost is.
Yeah.
If it's double that of an existing rig, it's very it's disincentivizing, or it's discouraging to start an oil rig, or basically put a rig online. Now there's some coming online here, but this is not you're not seeing. I mean, it's a steady climb, but you're not seeing it come back. I mean, in this amount of time, we back in 2018. If we go 2 years out, May 2016 to May 2018, we were basically May 2018. We were higher than where we are now,
So bottom
right?
line, what does this mean for inflation?
Right. So what this means is there's going to be a continued effort to export diesel. Remember, we have a winter heating season. The European Union's in trouble. They are having a problem getting heating oil. they are having a problem finding heating oil because the Russian pipeline stuff's on one day, off the next day. They don't know what's going on with this. So we're exporting. The American oil companies are exporting as much diesel as they can right now because it's very profitable. 75% margins. Let me put on the gas crack spreads, gasoline. It's almost 20% lower profit margins.
So they're not catching up.
Right now, if you go back in time, right? Let's go back to 2019. The difference here was diesel was at 26 and this was at 12, right? That's 14%. The spread is huge now. I mean, this is more equatable to 2018, where the diesel was trading at 31, and this was trading at still 17. I mean, that's what, 2024? That's about where we are right now.
And then
This,
eventually they
they
revert,
meet
right?
up,
It's mean reverting. Yeah, they meet up.
right? Yeah. Eventually, what ends up happening is they meet up again,
Hmm.
right? I think we have that over here. This is where we go over each individual crack spread. But this is just for the conversation of what's going on right now between crude and the crack spreads, and let's talk about why, what's going to prevent this from basically unfolding. Well, we say crude's at a multi-decade high, right? Like where were we at? We're at 20. Yeah, no, not multi-decade. We're at almost a decade high now in crude, right? That's what they're saying. It's the dollar that's a multi-decade high.
Yeah.
I'm sorry. So yeah, so we're at a decade high in crude, but our refineries are, if we take let's see, if we take we're at, what is it, 30%? Yeah, we're at 30% of 20. The last time crude was at these levels, we are running 30% or 70% less refineries, or not refineries, excuse me, oil rigs than where we were back the last time crude was at these levels. So that inherently is a supply crunch to begin with. So when you talk about demand destruction, number one, you're going to need to see the gasoline and crude spreads, gasoline and diesel crack spreads decline, right? Because that's going to disincentivize them. As these decline, it's showing that the exporting
Demand isn't there then.
the demand isn't there. Yeah,
Yeah.
exactly. So this is where we're going to go to our next chart, and this is basically showing crude against diesel or gasoline and diesel crack spreads. So what you notice about this is that these will meet up. As you look over time, they trade relatively together, right?
Yeah.
Besides 2012 through 2013, anywhere from 2011 to 2014 area, they trade close. So what does that mean? Well, crude is at 107. The barrel of diesel goes for 183, and a barrel of gasoline goes for 163. These need to meet in the middle. I'm not telling you crude's going to go to 150, right? Could it happen? Sure. But these need to meet in the middle. Until you see these break lower, where's the demand destruction? Look back here in 2014. These petered out and broke lower. Back in 2008, these topped, but they were close and broke lower.
Yeah.
We're so far right now.
We're not seeing that at all.
Right. What's going to happen? Well, they're going to produce. So think of it like this: as an equilibrium. They have to produce enough diesel to basically push the crack spreads lower, right? Because these crack spreads are going to entice rigs to come online. But the problem is like I said earlier, you have to amortize. You basically amortize, right? Yeah, I'm got a cloudy head today. You have to amortize the cost to start the rig up over the life of the rig, right? And if these crack spreads are enticing now, where are they 4 years from now? Are you gonna be in the shit, and like, are you gonna be making no money, or are you gonna be in the shitter or not?
Mm-hmm.
Like,
And
that's
so
what they look at.
We kind of have to get to that equilibrium where the margin isn't as good because there's more rigs out there, and then that's when you can see demand destruction. Essentially,
right? Or there's such a bad, or there's a deep recession where people just
don't need it anymore.
Don't need it. But remember, 50%, just think of it like this: 50% of the gasoline of the energy used in this country, almost 50% is gasoline, and we are at crack spreads that, last time we saw, I don't think gasoline crack spreads were ever this high, going back to
Yeah, this
84.
is like a
No,
once in a lifetime thing. First
right.
time.
They're like the last time gasoline crack spreads were this high. Um, excuse me. I have to. I'm gonna rephrase this because this is not accurate. These aren't the crack spreads as much as they are the price per barrel. The crack spreads would be the difference. Remember,
Right.
let me
Yeah.
clarify this. So this I've said crack spreads on this screen here when we're talking about the 160 $180 a barrel. That's not what they're making. That's not essentially the crack spread. That's the component of the crack spread. So the last time gasoline was above 150 a barrel, crude was trading at $140 a barrel.
Mm-hmm.
The
Okay.
last time both of these were, but the last time both of the gasoline and diesel prices per barrel were above 150, crude oil was at 140.
That's pretty
Or just
nuts.
about. Was gasoline, yeah, gasoline just hit 150. Literally. I don't even think it broke. 149.98. We'll round it up to 150. The last time they were at 150, and at that time diesel was trading like 170, 172. So the last time we were at these levels, these relative levels, oil was 40 points higher.
Yeah. So there's a huge incentive for oil refiners to produce as much as they can to make as much money as they can. And then
But
that,
why aren't they? Why aren't they?
well, because Russia's not producing anymore either. So
Right.
that's the supply crunch that we're in right now, right?
Well, Russia is actually exporting to India, but it's not so. It's that developed markets are having a hard time accessing it because all the developed markets have basically blacklisted Russia, besides maybe
Mm-hmm.
India and China, right?
Yeah.
But if you look at and remember, these are commodity prices here in the United States. These are NYMEX. These are here in America.
Yeah.
I believe these are USL. I don't know if they're Gulf Coast or if they're New York. I would assume that they're New York Harbor, but we'll have to look. I mean, it's not going to make that huge of a difference. Long story short, um, the price of oil, either one of two things need to happen. The price of oil needs to rise because look at it from this perspective. What I'm showing you right here is the price per barrel of everything. If oil were to go to 150, crack spreads would get crushed and it would basically disincentivize um, the exporting of these fuels because remember when you export something there's shipping costs, there's all these things. If the crack spreads get crushed, the price of we could basically use more of these oils domestically. You understand?
Mm-hmm. Yeah.
Like we're not going to export so much of it and the supply would rise domestically. But the foreign exports of all these oil of all these energy products remains elevated because you think the problem here is bad. It's much worse in Europe.
Yeah.
Now and then they had this energy grid issues, but we're not going to get into that. But that's where like they're overloading energy grids with electric vehicles, and I mean, that's beyond the scope of this conversation. Where some countries are having more of electricity problems than they are fuel problems. But besides the point, this one of two things has to happen here. Let's rope this back into the whole topic: monitoring inflation. You're gonna see these roll over when inflation is peaked
Mm-hmm.
because
Yep.
right now the demand is there. Remember just remember this: the gas companies don't set these things these prices per barrel. It's
They actually help bring this to equilibrium.
Yes, by increasing or decreasing
There's
production.
big demand. They're going to increase production. More rigs are going to open. and that brings it up to equilibrium where it eventually rolls over. You get demand destruction. There's
And then
supply has met up with demand.
right, and that's where
And then
rigs start rolling down again.
exactly. And we're not seeing that at all. Inflation has not peaked.
No, not yet. I mean, look, our rigs are not even at COVID levels. So just think of it like this: oil is higher than it was. Oil is higher than where it was back when we had 1,500 or 1,600 rigs. We only have 600 right now. So just think about the problem here. What needs to happen? One of two things needs to. This is a scenario how this works. Either oil rigs rocket up. Okay, that would fix this issue. And the spread here is also due to low refineries. I think there's only like 140 something refineries in the United States. That's ridiculous. It was over 300 years ago. Everything's cut in
Jeez.
half.
Yeah.
Yeah.
More but there's more
Demand.
need. Yeah, there's more demand.
Like, you look at if you look at a graph of cars on the road or houses or total supply of houses, everything's rising. So that means energy demand is going to go up, right? But you have less and less rigs. So how does this get subdued? And that's what I was saying before we spoke about cars and whatnot. But one of two things needs to happen: rigs need to explode higher, refineries need to explode higher. That's one. Or two, we need to have demand destruction to the point where crude falls apart. Now, the Fed can instill this by basically inducing a recession. Okay? Will they fix the supply problem? Not necessarily, but they can really crush demand where, I mean, you're talking like 2000. You're talking magnitudes of people being unemployed. Not because remember, if you're unemployed, you're not driving to work anymore, so you're just cutting a lot of gasoline demand
just
out of the
also
market.
all the factories and everything that use it. It's
and diesel, right?
They don't need to buy them anymore. So
everything's getting crushed, right? So what that's going to do is that's going to take the bid away from this value, bringing them closer, and they'll both fall together. But you need one of those two things to happen. So until you see crack spreads like roll over, and a good indication is we look back in 2011, 2010, we hovered around the 130. I said crack spreads. I'm sorry, the price per barrel rollover, because the price per barrel, the difference between the price per barrel of each of these and crude makes the crack spread. So back in 2011, we had the price per barrel of both gasoline and diesel hovering around 130 and 120, 130 a barrel. And once it couldn't really break above there, it fell apart. And you kind of saw that happen here early on in April. Gasoline, the price per barrel of gasoline bounced off that 130 mark too, and we're up. So until you see this under the 130 mark, because when there's demand destruction, this is going to go way down. So this is going to go lower. So is crude. But as long as it stays above the, excuse me, as long as it stays above the 130 mark, where's the demand destruction?
Yeah, and
that's what
in
we're
turn,
watching.
That in turn means bonds have not bottomed.
Right.
Back to that, like TLT, TMF, however you're planning on playing bonds if you're trying to catch the deflation pivot.
That's what's really important. What's really important that we mention. Just while we think the lows can come in, new lows can happen on ZN, which TLT means lower lows too. Just remember that even if you don't get the lower lows, you're chopping sideways until there's demand destruction. What I'm trying to say is until this rolls over, you're chopping sideways because there's going to be a bid for energy. There's going to be a bid for commodities. There's going to be a push high. As long as this stays up here, what I'm trying to say is this isn't going to stay up here and crude's going to go down. This is not going to widen more. This should be contracting. If this is widening more, it means that this is actually moving up faster than crude is moving up.
And that means things are getting worse.
Yeah, things are getting worse. So long story short, the price per barrel of both diesel and gasoline need to roll over. This spread, think of this spread is going to contract either way. So it's either demand destruction or higher inflation. Now, for the demand destruction to happen, as long as this doesn't roll under, and if this goes sideways and kind of does what this does here and rolls over, and go sideways, bonds are going to go sideways, or rates are like you're not going to see the destruction in inflation. Remember, inflation when inflation gets crunched, you see a deceleration in oil because energy is a huge part of CPI. So as long as this doesn't break down and go lower and really fall apart, I mean, you're going to get a slow in year over year as long as this goes sideways, but you're not going to see the rip that you need to see because you're not going to see the deflationary component of rates getting cut.
Exactly. So you'd be holding TMF or whatever, and
And that's the deadliest thing. Look at TM. The
yeah,
deadliest thing, yeah, is this.
you got the time decay in TMF.
Is this like
And at that point, like what is your trading plan if that's what you're trying to do? When do you get out? When do you realize, okay, I'm wrong? Is it after a year of going sideways, a year of wasted capital, holding
right?
this thing while it goes sideways?
Yeah, and that's the problem. That's why we haven't allocate. When we look at ZN, we haven't allocated anything because remember, let's go back to here. So as long like let me explain this to you. Let's really put this into perspective. If this goes sideways for more than 6 months to a year, then you're going to get deflation because what's going to happen is the year over year change is going to slow on a year over year basis, right? Because this is no longer going up. You understand what I'm saying? So
Mm-hmm.
you're going to like the Fed's going to have to basically you're going to get deflation. What I'm saying is if this does this type of stair stepper pattern, right? And this stays elevated and this doesn't roll over and this goes sideways and grinds higher, that's the problem. If this goes sideways and grinds lower, it's it's going to be good for bonds. But long story short, you don't want to see this move higher. That is going to be a sign that CPI is not done. The Fed needs to do more. That's where we are right now with our Fed rate hike model, which we showed you earlier. We're looking at 2 rate hikes, 1.5-ish, and then potentially another 2. If this that's with oil here. If oil starts ripping, because let's just say there's more of a supply crunch for whatever reason, call it summer heating or whatever, winter heating, excuse me. This goes up. Maybe we need to see the Fed do more, and that's what we're watching for. We want to put positions on with the sales in our back. When we get in, let's look at ZN. We don't mind. See the bottom here in ZN. We don't mind getting in here. The bottom in ZN, over here, we don't mind buying it when the regime's in our favor. And this is what we were talking about. This is not a quality regime. Here's a good example. The bottom's here. We would be buying it here. Yeah, it looks like we missed a big part of it, but we still get most of the move with leverage. It's concentrated returns. Here, what happens? This grinds up here, but this is not good what we want. We want solid returns. Because if bonds aren't moving anywhere and they're not doing anything, it means risk assets are probably doing something. There's always a place to go.
Yeah, exactly. And you're
So
just kind of wasting capital at that
yeah,
point.
yeah. Like let's just see what happened to TMF between 2013 and 2016. 2013. I mean, look.
Yeah, you got the theta decay in there as well.
I mean, it did rip at one point. You were up 61%, but you had this whole drawdown.
Yeah.
For what?
Which
For
you would have cut your losses.
yeah.
There's no way, like, what kind of person do you have to be to hold for a year, chopping sideways, doing absolutely nothing, and taking drawdowns and not cutting the position throughout that entire year?
Yeah, and it's also like, when does it work at this point?
Yeah,
Right?
after a year, you're going to start questioning yourself and thinking, okay, why am I still holding this? You're going to sell out of your position and then it's going to rip.
Right.
That's what's going to happen.
That's a stock market. That's a stock market. Whenever you sell, or the stock you wish you bought or the stock you sold, is always the ones that go up, and all the other shit you own goes in the toilet. That's like everyone's experience in the stock.
And we're just trying to help this. Like
prevent that.
We're helping. We're saying inflation has likely not peaked. The sales, like your sales, are not in the wind of the regime.
Right.
There's no reason to be buying bonds yet.
Until you see the price of gasoline and the price of oil peak and roll, right? Which will be a start of a compression of the crack spreads. Because remember, crack spreads are here, and we'll finish. We'll leave the podcast off on this. Let's overlay gas crack spreads and crude on a let's remove the actually let's hide these and let's just throw the crack spreads up. And this is the crack spread minus crude. This is the actual crack spread minus crude overlaid on crude. Okay? So, what needs to happen here? Well, let's take a look. Crude is not going to fall apart until the crack spreads do. The crack spreads are holding up at 180. They're actually off the lows. Let's look on a daily chart. Maybe this looks better. Look at crack spreads for gasoline. They bounce. Crude is still low.
Yeah, so they're creeping higher too.
Yeah, so that's just not a bearish sign for energy. Over. It's not a bearish sign for energy just yet. Because remember, when crude rolls over, so does the crack spreads. Like, let's look at 2008. By 2008, the crack spreads basically shit the bed before crude rolled over. So where are we now? We're here. So this is going to have to shit the bed soon. Or this can pull everything higher. That's what's important. Watch gas crack spreads, watch crude oil, and watch the price difference. The reason I showed you guys the price difference, which was right here, was just a simple view of what's going on. This shows you just a bird's eye view of what's going on here. What's the difference, right? The difference of what 1 barrel of crude is making. This is what you need to pay attention to. I'd recommend you guys put these tickers on your watch list. It's RB1 exclamation point times 42 because there's 42 gallons in a barrel, and HO1 times 42 because again there's 42 gallons in a barrel, and that's gonna give you the cost, or I should say the price per barrel, and then you're gonna look at the price per barrel of crude, and you're gonna see what's called the crack spread. And I think that's where we can leave this one off today. If you have any questions, reach out to us on Discord. Our Discord channel is linked on the website. You can, once you log in, there's an invite link. The website is www.market-radar.com. And just keep an eye out. Just watch what's going on. At the end of the day, inflation is not going to go from 8% to 1% in a day. You're not going to just end up missing the entire bond move. Take it slow, take it easy. The markets don't, especially the macro regime doesn't shift in 4 days, or in a week, or in a month. You have time. We've seen this whole market break down since February. It's been a slow grind lower, but we're going lower. But again, everything is elongated, slow. This is not COVID. A lot of people are getting confused that, the bond, they look at the bond move in COVID, this whole move here in TLT, and they're like, oh my God, I'm going to miss the move. This is not normal. The world shut down. The world closed. Okay.
Yeah,
rates went pretty much.
That's not going to happen.
Like this is normal. Look how much time you had to get into this TLT move. Okay, you didn't catch the bottom. You caught it here. We're still far ways from Momo. Could this bounce? Sure, this can go up to Momo. Would it suck? Yeah, but guess what? Odds are that by the time that we get deflation, this will have caught up. And that's what we want to tell you, because at the end of the day, the last thing you want to do is be playing with bonds. Yeah, you get a dividend, but if you're leveraged, because that's the way you make real money, is running proper leverage. If you're running proper leverage in this, which is TMF, and this doesn't actually go higher or go where you want it to go, and you're not moving positions fast enough, you're going to get data decay. It's going to be terrible. And we don't want that. That's why we're basically taking our time, take our shots with the regimes in our sails.
Rule number one,
we're going to leave it up.
Capital preservation.
Yep. And I think that's a good place to tie it off.